Right now, half the world is bracing for $150 oil because, well, a single physical shipping lane is under fire.
Right.
And meanwhile, you have these billion-dollar physical hardware companies just collapsing overnight because a single piece of digital math just made their products completely obsolete.
It is wild to watch.
It really is. Welcome to the collision of the physical and digital worlds, everyone. It is Tuesday, March 31st, 2026. And for you listening, our mission today in this deep dive is to make sense of a truly chaotic week.
Yeah, chaotic is an understatement.
Seriously. We're watching geopolitical conflicts in the physical realm violently collide with these. Exactly. We are going to map out exactly how global wars, algorithmic elites, and biotech revolutions are, far more interconnected than they appear on the surface. So, okay, let's unpack this. Let's start with the traditional markets, which are taking an absolute beating right now.
Oh, yeah. I mean, the indices are flashing some of the most aggressive risk-off signaling we've seen all year.
Looking at the data from CNBC, the S&P 500 dropped 1.67% to right around 6,368. The Dow is testing 45,000 after an 800-point slide.
Which is brutal.
Right.
Yes.
And the NASDAQ has fallen over 2%. And the root cause here, it isn't a bad earnings report or like some subtle shift in consumer spending. It is entirely geopolitical.
100%.
We are entering the fifth week of the ongoing conflict in the Middle East, and the theater of operations is just widening. Yemen's Iran-backed Houthis have now fired missiles at Israel.
And that geographic expansion is the specific catalyst that is just terrifying the commodities markets right now.
How so?
Well, the Houthis effectively control the coastline along the Red Sea, right? Which is this massive artery for global shipping. Yeah.
When you combine that instability with the looming threat to the Strait of Hormuz on the other side of the Arabian Peninsula,
You get a chokehold.
exactly.
Yeah.
You are looking at a dual chokehold on the world's energy supply infrastructure. And we are seeing the pricing reflect that immediate physical constraint. Brent crude just crossed $115 a barrel.
Wow.
Yeah, and WTI crude is topping $100.
So oil is the obvious casualty there. But our sources at 247 Wall St. highlight this really fascinating secondary shockwave. Aluminum prices just spiked violently.
Oh, the aluminum spike is crazy.
Because Iranian strikes hit critical Middle East smelting infrastructure, right?
Right.
Alcoa stock actually shot up 10% purely on the anticipation of a massive global aluminum shortage.
Yeah, and you have to remember, aluminum is often referred to by commodities traders as solid electricity.
So all electricity, I like that.
Yeah, because the smelting process is so incredibly energy intensive. If you damage the power grids or the physical smelters in an energy-rich region like the Middle East, you immediately remove massive amounts of supply from the global market. Which brings us directly to the political response, and specifically, statements from President Trump regarding the escalating conflict.
Right.
And just to pause here for you listening, our goal isn't to weigh in on the politics of these statements from either side. We strictly want to look at how the commodities markets are pricing in these explicit warnings as tail risks.
Exactly. We're just looking at the market reaction.
Right. We are neutrally relaying these statements straight from the source material to understand the macroeconomic fallout. So, according to the reports, President Trump posted on Truth Social claiming that progress is being made with what he called a new regime in Iran to end military operations.
But there is a massive caveat there.
A huge one. He followed that diplomatic claim with a very severe ultimatum. He stated that if a deal isn't reached shortly, and if the Strait of Hormuz is not reopened, the U.S. will obliterate Iranian electric generating plants, oil wells, and Karg Island.
And Karg Island is the linchpin there. It handles roughly 90% of Iran's crude exports.
90%?
Yeah. So the markets are currently trying to price in a binary, highly volatile outcome. Investors are basically looking at a pendulum, swinging between a diplomatic breakthrough that could instantly cool the region and a catastrophic strike on Karg Island that would effectively erase millions of barrels of daily supply.
Which would easily send crude testing $150 or even $200 a barrel.
Without a doubt.
And while the commodities markets are having an absolute panic attack over this physical infrastructure threat, the Federal Reserve is, well, essentially sitting on its hands.
They really don't have a choice.
Right. Fed Chair Jerome Powell was speaking at Harvard, and he effectively took interest rate hikes completely off the table. He stated that monetary policy is in a good place and noted that raising interest rates won't fix high gas prices.
Powell is publicly acknowledging the mechanical limits of central banking there.
Yeah, explain that, because that's an important distinction.
So the Fed's primary tool to fight inflation is demand destruction, right? They raise rates to cool down borrowing and spending, but the inflation threatening the market right now is supply-side driven. It's physical.
Exactly. A missile strike on a refinery creates a physical shortage of refined fuels. Powell knows that raising the federal funds rate does absolutely nothing to repair a damaged smelting plant or clear a shipping lane.
So he's trapped.
Totally trapped. He is forced to watch geopolitical forces dictate the inflation narrative.
You know, I look at the global economy right now like a tightly wound spring. It feels so rigid, so maxed out, that just one snap in a place like the Strait of Hormuz and the whole machine rattles.
That's a great way to put it.
But let me push back a bit. Are these market drops we are seeing just a temporary panic over the spot price of oil? Or is this like a fundamental repricing of global risk?
Well, it is absolutely a fundamental repricing. Markets can model and digest bad news. They do it all the time. But they are completely paralyzed by uncertainty.
Right.
Right now, algorithmic trading models and human portfolio managers alike, they just don't know if they are waking up tomorrow to a peace treaty or a burning Karg Island.
And that uncertainty bleeds into everything. Exactly. That specific uncertainty around physical supply chains bleeds into everything. If energy and raw materials like aluminum skyrocket, then transportation and manufacturing costs surge, which inevitably crushes corporate profit margins across the board.
And that margin compression fear is exactly why the Dow and the NASDAQ are bleeding.
Exactly.
Okay, so this macroeconomic fear environment usually triggers a massive rotation. When inflation threatens and the physical world is in conflict, capital historically searches for alternative stores of value, right?
Yeah.
Highly volatile risk assets that sit outside the traditional banking system.
Which brings us to the current state of cryptocurrency.
Exactly.
If we connect this to the bigger picture, the core thesis of crypto, particularly Bitcoin, has always been its immunity to physical supply chain shocks. It is digital scarcity. It's theoretically insulated from blocked shipping lanes or bombed refineries.
Theoretically, yes. But the actual market data paints a much more complicated reality than that utopian thesis.
Oh, for sure.
According to INN and Blockchain Magazine, Bitcoin is hovering right around $67,000 to $68,000.
Yeah.
Now, that is down 45% from its October 2025 all-time high of over $126,000.
Yeah, the broader market sentiment indicators are just flashing extreme fear right now.
A 45% drawdown in 6 months creates massive friction.
It aggressively shakes the conviction of retail investors, and it leverages speculative traders right out of their positions.
But the sources reveal a staggering contradiction under the surface of that price action. Because despite this extreme fear dominating the retail narrative, institutional adoption is absolutely beaming.
It really is.
BlackRock's IBIT Bitcoin ETF is trading between $16 and $18 billion daily. That kind of volume is nearing the spot trading numbers of massive native crypto exchanges like Binance. Wall Street is fully engaged.
Wall Street institutions are basically bypassing the chaotic offshore exchanges and utilizing heavily regulated compliant vehicles like ETFs.
Right, they want safety.
Yeah, they are routing client capital into Bitcoin through the exact same plumbing they use for treasury bonds and tech stocks. The custodial risk is handled by traditional financial custodians, which completely removes the technical hurdles that previously kept institutional money on the sidelines.
But then you look at the other side of the industry, and it's a completely different universe. We have two massive regulatory crackdowns making headlines this week.
Yeah, the contrast is crazy.
First, the U.S. government seized $1.2 billion in a money laundering sweep dubbed Operation Hidden Ledger. Second, a major crypto firm called Goliath Ventures just filed for Chapter 11 bankruptcy.
And it gets worse.
Much worse. Their CEO, Christopher Delgado, was arrested for running a $328 million Ponzi scheme. He was actively using new depositor funds to pay out early investors while financing a luxury lifestyle.
It was literally just a structural Ponzi scheme operating under the guise of complex, decentralized finance yields.
Wait, so hold on. Wall Street is pouring billions into Bitcoin through BlackRock, cementing it as a legitimate asset class, while at the exact same time, federal agencies are busting billion-dollar money laundering rings and massive Ponzi schemes right next door.
Basically. Yeah.
How can these two entirely different realities coexist in the exact same asset class?
Well, cryptocurrency is enduring a very painful, very public adolescence. It is caught squarely between its unregulated speculative origins and its heavily regulated institutional future.
That makes sense.
Right. The massive inflows into the BlackRock ETFs represent the asset class integrating into the traditional financial machine. But the collapse of Goliath Ventures represents the lingering shadows of the early days where grifters could hide behind convoluted blockchain jargon to obscure basic fraud.
So it's a purge.
Exactly. That extreme volatility we are seeing, that 45% drop, is the market physically purging the bad actors and over-leveraged speculators, while the institutions quietly build the actual long-term infrastructure underneath the chaos.
Okay, so while crypto deals with that friction and the broader markets react to physical geopolitical constraints, the technology sector is experiencing a localized earthquake of its own.
Oh man, yes it is.
And this shockwave is completely detached from oil prices, interest rates, or Middle East conflicts.
This is a pure algorithmic leap. It's a technological shockwave that is actively destroying existing business models.
Our sources from 24/7 Wall Saint and the Motley Fool are reporting on a massive, kind of quiet announcement from Google. They've developed a new AI memory compression algorithm called TurboQuant.
TurboQuant is going to change everything.
It seems like it. This algorithm can reduce the memory needed to run massive artificial intelligence models by up to 6 times. Cloudflare's CEO, Matthew Prince, was quoted calling this Google's DeepSeek moment.
And to understand the gravity of that statement, we really have to look at the underlying mechanics of how AI has scaled over the last 5 years.
Right, because it's always been about bigger is better.
Yeah, exactly. The industry assumption has been that smarter AI requires brute force scaling. You build a larger data center, you pack it with more advanced GPUs, and most importantly, you surround those processors with an ocean of high bandwidth memory chips.
Right.
In large language models, the processor itself usually isn't the bottleneck. The bottleneck is moving the massive data set from the memory to the processor. Memory bandwidth has been the absolute ceiling on AI capability.
Which is why the companies manufacturing those memory chips have been printing money for years.
Unbelievable amounts of money.
But here's where it gets really interesting. The immediate market fallout from TurboQuant. Because this algorithm fundamentally changes how data is compressed and processed, the companies selling the physical hardware to support the old brute force models are tanking.
Overnight.
Literally. Micron Technology fell nearly 10% on incredible trading volume. Western Digital dropped 8.6%, and SanDisk fell 7%.
Because the market had modeled valuations for these hardware companies based on a future where AI demand for memory would scale infinitely.
And now it won't.
Right. TurboQuant proves that software optimization can drastically shrink that demand overnight. By using advanced quantization techniques, which is essentially dropping the precision of the mathematical weights in the AI model without losing the quality of the output, Google has shown that you don't need a massive cluster of memory chips to run a state-of-the-art model.
It's like someone just invented a car engine that gets 500 miles to the gallon, and suddenly all the gas station owners are panicking because the fundamental demand curve for fuel just collapsed.
That is a perfect analogy.
But let me ask you, does TurboQuant actually mean the AI hardware boom is over? Or does it just change what kind of hardware is valuable?
The broader boom isn't over, but the structural nature of it is permanently altering. We are shifting from an era of raw, brute force hardware scaling to an era of algorithmic efficiency.
Okay.
Elegant, highly optimized software logic is beginning to outpace raw physical silicon. And this forces portfolio managers to aggressively rethink their tech allocations.
Because the deployment economics change.
Entirely. If an AI model requires 1/6 the memory to run, you can begin running incredibly powerful, specialized AI locally on a smartphone or a factory edge server instead of routing everything through a massive, power-hungry server farm.
Wow.
The value capture shifts away from the companies manufacturing the physical chips and directly toward the companies that can apply these highly efficient AI models to solve complex, real-world problems.
And that shifts from brute force hardware to highly efficient algorithmic logic isn't just a tech story. It's the exact mechanism unlocking AI for the physical world. Because AI models are now cheap and efficient enough to run complex simulations locally, they're completely rewriting the economics of human health and biotech.
We are watching generative AI evolve from predicting the next word in a sentence to predicting the three-dimensional structure of entirely new biological therapeutics.
It's mind-blowing. The capital flowing into AI biotech right now is staggering, according to Biospace and Pharma Forum.
Huge numbers.
Eli Lilly is investing up to $2.75 billion within Silico Medicine to build an AI supercomputer dedicated exclusively to drug optimization. Verily just raised $300 million to scale its AI platform.
And don't forget Latent Labs.
Yes, Latent Labs just launched an AI agent called PandaClaw. PandaClaw is a generative AI that designs therapeutic antibodies from a simple text prompt. It takes weeks of painstaking expert lab work and compresses it into mere hours.
Because generative biology operates on the premise that proteins are essentially sequences of amino acids, right? Which an AI can read and generate much like tokens in a language model. It bypasses the need for massive physical screening.
Right.
But this raises an important question. If we are seeing this explosion of capability and investment in AI drug discovery, what is happening to the traditional pharmaceutical giant?
And that is the glaring contradiction in the data today. While billions are pouring into these agile AI biotech startups, the traditional giants are pulling back.
Pulling back hard.
Overall research and development spending among the top 16 pharmaceutical companies actually dropped at 3.6% in 2025, falling to $159 billion.
Which is historically very unusual.
And they are executing massive layoffs simultaneously. Takeda is cutting over 600 U.S. staffers. We are seeing deep cuts at Amgen, Series Therapeutics, and even at the Federal Research Agency, ARPAH.
Yeah.
So I have to push back here. If AI is making drug discovery exponentially faster and more capable, why on earth are the biggest pharma companies slashing their R&D budgets and laying off hundreds of researchers?
Because traditional drug discovery is built on a legacy model of physical trial and error. You synthesize thousands of chemical compounds in a wet lab, physically test them against a disease target, and basically just hope one binds correctly.
Sounds expensive.
Oh, it is. To use an analogy, traditional pharma has been trying to pick a lock by forging millions of random physical keys and trying them one by one. It is incredibly expensive, it's painfully slow, and it yields a 90% failure rate in clinical trials. So the budget cuts and layoffs aren't signs of scientific failure. They are the blunt symptoms of a massive structural transition. AI allows these companies to take a digital X-ray of the lock and 3D print the exact key on the first try.
Wow.
AI is doing the heavy lifting in dry labs, simulating how molecules will interact before a single physical compound is ever synthesized.
So they simply do not need armies of lab technicians running thousands of failed physical experiments anymore?
Exactly. They need fewer traditional pipettes, fewer giant physical lab footprints, and vastly more computational talent.
Which is a huge shift.
It is a highly disruptive transition for the scientific workforce, but for the fundamental economics of the industry, it is revolutionary. They are spending less on R&D overall because AI is making the R&D process itself exponentially cheaper, faster, and more targeted.
Man. So what does this all mean? Let's bring this full circle for you, the listener.
So,
We've navigated a massive amount of complex territory today in this deep dive.
we really have. From the Strait of Hormuz to Bitcoin ETFs.
Exactly. From Google's memory compression to AI-generated antibodies. But whether you are managing a retirement portfolio, navigating supply chain inflation, or wondering why the tech stocks in your 401k are suddenly volatile, or hoping for a breakthrough medical treatment for a loved one, you are living at the exact intersection of these opposing forces.
The physical and the digital.
Right. You are caught between the rigid constraints of the physical world oil routes, geopolitical wars, fragile supply chains, and the infinite expansion of the digital world, where algorithms like TurboQuant make physical hardware obsolete and generative models design life-saving drugs in an afternoon.
The physical world is currently defined by friction, scarcity, and conflict, while the digital world is defined by hyper-accelerating algorithmic efficiency and optimization.
Beautifully said.
Well,
And as we close out today's deep dive, we want to leave you with one final thought to mull over. We spent time detailing how Google's TurboQuant algorithm fundamentally altered the hardware landscape and how PandaClaw can design a complex therapeutic antibody from a basic prompt.
so consider the trajectory we are on. What happens when these advanced AI systems cross the threshold where they begin redesigning their own underlying architecture, completely independent of human engineers?
That is terrifying, but fascinating.
Right. If human developers could compress memory usage by 6 times in a single leap, what level of efficiency can an AI achieve when tasked with optimizing its own code? Are our financial markets, our corporate structures, or are human regulators even remotely prepared for a pace of innovation that moves exponentially faster than we can track?
We are trying to navigate a physical world using a digital map that keeps rewriting its own geography, faster and faster, right before our eyes. Thank you so much for joining us on this exploration today. We hope you walk away with a much clearer picture of the mechanics shaping our world, and we warmly invite you to join us for our next deep dive.